Mary, how are you?
Well, thanks, Jesse, and how are you?
Pretty good. I feel a bit bad. I get a bit excited when the markets have a big plunge. I know it's a lot of people's livelihoods, but it's quite exciting to watch, seeing the headlines roll in, asking, is this the big one or is it not?
It's even more exciting when it turns back up again, I think. I always
I even
think,
considered staying up till midnight for the opening of the New York Stock Exchange the other night when Japan had dropped by 12% or something. I thought, well, all eyes on the Dow Jones and the Nasdaq. So,
yes.
Anything? This is not the topic of your interview today, but anything you wanted to say about the some of the headlines this week about big drops in international equity prices?
Yeah, just that I hope everybody by now has seen what happens to their KiwiSaver funds, because before the COVID plunge, there was a long period where there weren't very big drops in the market, and I think a lot of people got a shock when the markets dropped so fast. And for quite a long way in the beginning, early months of COVID. But then it recovered awfully fast too. And I just hope that people now, when they hear the news that the Dow Jones is down or the Nikkei's down or whatever, just say, oh look, okay, I'll just hang about, it'll come right.
Yeah. You get lots of emails when things are tracking down saying, should I be doing something?
A little bit, yeah. I think not as much as I used to, I think, which is a good sign.
Yeah.
I hope people are realising. I mean,
your efforts to educate the nation are paying off.
Well, the people that read my column and listen to you, perhaps, but it's come right again, and look, and that quite often happens. But
if you're in the right KiwiSaver account for you, you don't need to worry whether the market's going up or down. Going up or down, going up and going down is part of the plan.
It is for the higher risk, the aggressive and growth funds, etc. And the middle level, the balanced funds, have usually got quite a few shares in them, so they get a sort of modified version of whatever's happening in the markets. But yeah, if you did worry this week, that's a sign that you should perhaps consider reducing your risk. But just move it down once and then don't mess with it anymore. You're not allowed to keep moving it up and down.
You're talking about temperament.
Yeah.
Yeah. If you're the sort of person who gets too anxious about the drops in the share market, then maybe a growth fund isn't for you.
That's quite right, yes.
Well, we're sort of on track for today's theme.
Yeah. I wanted to talk about index funds, which you and I haven't talked about for quite a while, actually. But they're a type of share fund, and I'll get into that detail in a minute. But what I want to say applies to KiwiSaver, so a lot of listeners, especially if you are in the highest risk aggressive funds or growth funds, which are the ones that have got the most shares in them, you can, within KiwiSaver, be in an index fund, or you can be in an active fund. And they're basically, share funds are divided into active and passive or index. And back in the early 70s and earlier than that, there were only active funds, which are just the ordinary share funds that the people who are running the fund buy the shares, and they choose companies they think are going to do better than average in their performance and buy shares and then sell them when they think, perhaps when they've done really well or whatever. They're in there trading the shares in the fund. And then in the 70s, and I was actually really lucky to be had a front row seat right at the beginning, because I was studying finance at the University of Chicago, and that was the academic research was coming out saying, hey, there's another way to run a share fund that we think is going to do better. And then and I was learning about this and thinking, this is pretty neat. And I actually also worked for the Chicago Tribune as a business reporter, and so I wrote a few articles about it when Vanguard was the first company, I think the first of all of them, to start actually selling those sort of funds to ordinary people. And I put a bit of my savings in, and when I left America, I moved my pension money, my equivalent to KiwiSaver, into Vanguard funds. and just left it there from the 1970s. And it wasn't a hell of a lot of money then, but it's quite a lot more now.
Yeah.
Because you just sit there in those funds, they're very low fees, and they go up and down, but they grow over the long term. So I've been sort of talking about index funds in my column since really the 1990s, when in New Zealand the first one was called Tens. It was the top, based on the top 10. And then there was WINS, which was international share funds. I think they were the early New Zealand index funds anyway. But
That was when I started reading you.
was it? Yes.
Yeah. There was launched one called the Fonds.
That's
which I thought
right.
was pretty cool because I was a big Happy Days fan.
Yes, it was. That was 5 or something.
50 of New Zealand's.
50, the top 50 in New Zealand. That's right, yeah. And since that time, index funds and passive investing in general has really taken off in America. It's become huge over there. And it's sort of catching on in New Zealand too, because basically their fees are low, and on average they perform as well as the active funds before fees. And when you get the fee advantage in there, they tend to be a better long-term bet. But what happened this year? Oh, and I should mention exchange-traded funds here, which are basically index funds that are traded on the share market. And so you can, if you want to invest in those, you go and buy shares in them on the share market, or you can do it through Sharesies and Stake and Hatch and different platforms. So we're talking here about both exchange-traded funds and index funds, which are in KiwiSaver and non-KiwiSaver type investments. Yeah. So what happened this year was SPIVA, which is spelled SPIVA, and it's connected to S&P, the S&P 500 and Standard & Poor's American company. And they've been doing research for years on American index funds, and then gradually have expanded to include quite a lot of other countries. And this year, in their report on Australia, for the first time they included New Zealand. So they got data from Morningstar, which has anyone who wants to check New Zealand KiwiSaver or non-KiwiSaver fund performance, Morningstar does a report every quarter. So these SPIVA people said, hey, let's have a look at what's happened in New Zealand at the actively managed share funds, the traditional ones, versus the market index. I haven't explained really the index thing, that index funds invest in all the shares in the share market index, like the NZX 50 or the S&P 500 or whatever, and just hold those shares. Yeah. So they're holding shares across a big range of the market, and they don't trade them.
Any buying or selling they do is automatic, just to keep the same balance of the top 50 shares.
Every now and then they sort of, but when the index changes, and the indexes change, I think, quarterly or...
I'm not sure, but they're not making any judgments anyway.
No, that's right. They just follow the index. And so that's why their fees are lower, because they don't have to hire a whole lot of people to crunch all the numbers and see which companies look good and which ones don't. They just buy the shares in the index and sit there quietly and smell the flowers. So anyway, SPIVA had a look at New Zealand, and it found that over a single year, 54% of the active funds perform better than the index, i.e. better than index funds. And that, so 54%, about half, perform better than the index. And that's what you would expect in a single year. The active funds are all over the place. Some of them do have a good year and some have a bad year. 54% did better. But when you look over 10 years, it was only 25% that kept on doing better. Because what happens is the different active funds, they'll perform well one year and not so well the next year. Yeah. And so when you're looking at over a longer period, fewer and fewer of them are actually beating the index. And I maintain people should take a lot more notice of the 10-year performance than the 1-year performance, because if you're in these sort of investments that are heavily invested in shares, you should have a 10-year horizon. It's too easy for the for the markets to go down over a single year. They quite often do. So this is long-term investing. We're talking about people who are, if it's in KiwiSaver, it's people who've got more than 10 years before they buy a home or take money out in retirement. So looking at the 10-year numbers, we've got 25% of the active funds doing better. So that basically means that if over the next 10 years, if you choose an active fund, there's a 1 in 4 chance that it'll do better than the index, 3 in 4 chance that it won't. Whereas if you're in an index fund, it's chugging along being the index.
Yeah, that's fascinating.
Yeah,
that confirms, I mean, that's new research, but it confirms your hunch and the evidence that you've found before on this, right?
Yeah, from other countries.
Yeah.
You know, it's
but great to see it here in New Zealand, where sometimes we're told that things are a little bit different because we're a small market and these fund managers might have special access or special knowledge.
That's what they say. And in fact, when I looked at the international shares that New Zealanders are investing in, the funds, New Zealand-based funds, but they're investing in shares all around the world, only 19% beat the index in 1 year, and over 10 years just 6% beat it. So, and I maintain people actually should be in funds that invest broadly internationally, not just in New Zealand shares. It's a good idea to be in a fund run in New Zealand, but one that in turn goes and buys international shares. Then you don't have to worry about exchange rates and all of that kind of stuff. That's in international tax. That's all taken care of for you. But that's the way to go. And when you look at those funds, the active ones do really poorly over 10 years compared with the index funds. As Brent Cheeser, I don't know whether you know him. He's a financial advisor down in Mount Maunganui way. He's a surfer as well. He does put a post. He's a neat guy.
Yeah.
And he says outperformance generally does not persist, i.e. outperformance being doing better than the index. Yeah. But fees do. You know, the fees stay lower for the index funds.
Yeah.
So
actually, you're saying that, I'm not sure if I've considered this before, but even if the performance was exactly the same between an index fund and an active fund, you'd still be worse than the active fund because the fees would be higher.
If the performance before fees, that's right. Yes, you've got to consider that. And so actually when it all boils down to it, I suspect some listeners might be a bit, oh God, I can't keep track of all of this. Basically, I'm saying go for the low fees because they're nearly always, when you're looking at KiwiSaver or non-KiwiSaver funds, nearly all of the low fee ones are the index funds, and they just generally are a better bet.
This is great advice, by the way, and we'll sum this up in a moment. I'm just going to jump out of this for a moment to say that we don't have a correct answer on link 3 yet. But all of the following guesses are on the right track. Are they all from MTV? No. Are they all from the Wedding Singer album? No. Are they all from the We Are the World album? Not sure there is such an album, but no. Are they all from the movie Beverly Hills Cop? No. But guys, keep thinking you're not far away. I'll give you another song if we need it. So how should we conclude then, Mary? What are the main points?
Well, to choose an index or passive fund, and if you're confused by how to do that, just go for the low fees or an exchange-traded fund. They're sometimes called ETFs, short for exchange-traded funds, which are basically the same thing, but they're traded on the share market. They're not necessarily better or worse than the other ones. In KiwiSaver, if you're thinking, I want to move to one of these funds, which is a great idea for people who can cope with the high volatility of these sort of funds. There'll be ups and downs. Sometimes they've got the word index or the word passive in the name of the fund. Yeah. Or you can just look at on the Smart Investor tool on Sorted, one of my favourite online tools. If you look at the writing, they've got a couple of sentences about each fund, and they'll tell you if it's a passive or sometimes they talk about it tracking the index. This fund tracks the NZX 50 index or whatever. Outside KiwiSaver, you might want to go into one of these exchange-traded funds. Smart Shares, which was the company that first sort of did them in New Zealand, and they've got a wide range of index funds or passive funds that are exchange-traded, that specialise in different countries, and that I think it's best just to go with international myself. But you can also get them via, as I think I mentioned before, on Hatch, Sharesies, Stake, those sort of platforms. And Money Hub, which is a personal finance website that's got a lot of good information on it, they were pointing out that sometimes you can get into the same Smart Shares funds but at lower fees via Hatch or Sharesies or Stake. So this is for people who want to put a bit more effort into finding the right thing. That might be the way to go. I mean, I haven't tested that myself, but be aware of the different options you've got to get into those exchange-traded funds. Just a couple of other main points. When you're looking at returns, look at the longer term. Don't look at 1 year returns. They're because so often the ones that do well 1 year don't do so well in another year. Don't look at returns without comparing them with the index. In some years, there was a recent year after the markets plunged from the COVID, that happened right around March 31st. And so in the following year, that we went April 1 to March 31st, there were huge rises in all these share funds because they all
had the dip
started
gosh.
from a very low point. They were all sort of 30% sort of.
Well, that would look good in everyone's annual reports.
Yes. And the point is that quite a few, a fund will say, look, we had a 25% return back then, and you say, that's fantastic. Look at the index and you'll find it did even more. Yeah. Don't just look at the raw numbers. The other point I wanted to just quickly make is that this August is Money Month on the Sorted website, and they so if you look at sorted.org.nz, they start out with some cute stuff, some excuses for why you shouldn't look at your money, and couple that I like. One was, I'm taking the midnight train going anywhere rather than looking at my money. And another one had a cute picture of a cat and it says, my cat's in a neighbourhood scandal, so I can't look after the money. So they're kind of fun. But then underneath that, they've listed a whole lot of tools that you can use, lots and lots of around the country of free webinars or free seminars, in-person seminars,
cool.
where people can go along on, let's say Wednesday, the 13th of August. It probably isn't the 13th, but at 2 p.m. we've got a seminar for retired people at such and such a place, and a lot of them are free. So there's all sorts of
And they're
resources.
a neutral organisation, so you don't need to worry that they're going to be trying to sell you something.
That's right, yeah.
Thanks,
Those are
Mary.
good stuff. Pleasure.
Sorted.org.nz